watching Big Brain Energy.
Taxing certain items affects producers and consumers in different ways, depending on the elasticity of demand. Who bears the brunt of a tax is what we call the incidence of tax, and this is what we're going to cover in depth today. This is the last video in a 5-part series where we cover everything you need to know for the elasticity topic within NCEA 3.3, demonstrate understanding of microeconomic concepts. In this context, the tax is an excise tax placed on a good or service. The purpose is to make the thing more expensive so that people buy less of it. For example, taxes on cigarettes or alcohol. How this tax works is that the government tells, for example, the cigarette company, that for every pack of cigarettes they sell, they have to pay $2 tax to the government, or however much the government specifies. The cigarette company will therefore probably raise the price of the cigarettes so that the consumers can cover that tax. To illustrate a tax, we start with a regular demand and supply graph, showing equilibrium price and quantity. To illustrate the tax, we draw in a curve to the left of the supply curve. Make sure that it's parallel to the supply curve. We label this tax, or sometimes it's labeled S plus tax. It's all the same. Now we go ahead and draw in the new equilibrium, where the demand curve crosses over the tax curve. We call this QT for tax, and PC for the price that consumers are charged with this tax. You can see that the price consumers are charged is higher than the original amount, because now they have to pay that tax too. Then we need to draw in the price that producers receive. We go out from the point where that QT line hits the supply curve. We label this PP for the price that producers receive. You'll see that this is less than the original price. So when there is a tax placed on something, then the business has to pay that tax and therefore receives less money. This box is the value of the tax. You can see that it's the distance between the price that the consumers pay and the price that the producers receive. It applies up to the quantity that is brought under the tax, QT. This is the money that the business sends to the government as tax. That total tax revenue is partly covered by the producers and partly covered by the consumers. The extra amount that the consumer pays goes towards the tax revenue, so the distance between PC and PE. The amount less that the producers receive goes also towards the tax revenue, so the distance between PP and PE. On this graph, you can see that those amounts are pretty even, so the consumers and the producers split the burden of the tax pretty equally. However, when the elasticity of the item is different, these burdens do not get shared so equally. We'll now look at the difference between taxing an elastic item and an inelastic item. If the good or service has elastic demand, then its demand curve is going to be relatively flat. Elastic demand means that a price change results in a relatively larger change in quantity. It's things that people are quite sensitive to price changes for, like maybe eating out at a restaurant. If that suddenly became quite expensive, then way less people would stop eating out. Or like butter. When the price of butter is quite high, people buy way less butter and maybe just buy some margarine instead. When we add in the tax curve and label the resulting PC and PP, we can see that the extra amount that the consumer pays is pretty small, but the amount less that the producer receives is quite a lot less. This results in the tax paid by the consumer being pretty small, and the amount paid by the producer being pretty big. So, for a tax placed on elastic goods, the incidence, or the burden, falls more on the producers. Basically, if consumers are pretty sensitive to price changes, then the producers don't want to make them pay too much more because they'll lose all their customers. So it's better for the producer to just cover most of their costs themselves. The producers will absorb more of the tax themselves to keep the price rise lower and prevent the quantity demanded from dropping too much. For a tax on inelastic goods, the opposite is true. For a tax placed on inelastic goods, the incidence falls more on consumers. The producers will pass more of the tax onto the consumers as they are less concerned about the quantity demanded dropping. Inelastic demand means that the change in price is proportionately larger than the change in quantity. It means that even when the price increases, people will still buy heaps of it anyway. For example, petrol, or rent, or electricity. Even when these things get expensive, people still buy a lot of it, right? They might buy a little bit less, but not heaps less. Something with inelastic demand has a steeper demand curve. Let's have a look at what happens when we draw in the tax. You can see that having a steeper demand curve results in the price consumers pay under the tax, PC, increasing by quite a bit, whereas the price that producers receive under the tax, PP, is only a wee bit less. This results in the tax paid by the consumer being pretty big and the amount paid by the producer being pretty small. So, for a tax placed on inelastic goods, the incidence or the burden falls more on the consumers. Basically, if consumers aren't that sensitive to price changes, then the producers will take advantage of this and make them pay most of the tax because they'll just pay this higher price anyway. So, with inelastic demand, the producers will pass more of the tax on to consumers as they are less concerned about the quantity demanded dropping. There's really only one more thing to note. The government prefers taxing inelastic goods because they receive more tax revenue. If we were to compare the two situations, we can see that taxing inelastic items results in only a small decrease in quantity, whereas taxing elastic items results in a fairly big decrease in quantity. So the amount brought under the tax on inelastic items is more than the amount brought for elastic items. If there are more things being brought, then there's more tax getting paid. So the government makes more money off of the inelastic items. Think about, for example, cigarettes. Cigarettes are something that people buy even if there is a big tax placed on them. The government can actually take advantage of this and get heaps of tax money off of cigarettes. However, is that really fair? Well, that's another question. Taxing something like cigarettes with inelastic demand isn't really that effective in achieving the goals of reducing the amount that people buy, because people still buy them anyway because they're addicted. And now we're just making life even harder for these people who are addicted, who are likely already low income or struggling with other aspects of life. Anyway, that's something you might want to think about. Here's a full summary of the key things you need to know. For a tax placed on inelastic goods, the incidence falls more on producers. The producers will absorb more of the tax themselves to keep the price rise lower and prevent the quantity demanded from dropping too much. For a tax placed on inelastic goods, the incidence falls more on consumers. The producers will pass on more of the tax to the consumers as they are less concerned about the quantity demanded dropping. And the government prefers taxing inelastic goods because they receive more tax revenue. Let's reinforce these new learnings with some practice questions. When there is a tax on an elastic good, who bears the incidence of tax? The answer is the producers. The producers will absorb more of the tax themselves to keep the price rise lower and prevent the quantity demanded from dropping too much. When there is a tax on an inelastic good, who bears the incidence of the tax? The answer is the consumers. The producers will pass more of the tax onto the consumers as they are less concerned about the quantity demanded dropping. Why do producers bear the incidence of tax for goods with elastic demand? The producers will absorb more of the tax themselves to keep the price rise lower and prevent the quantity demanded from dropping too much. Why do consumers bear the incidence of tax for goods with inelastic demand? The producers will pass more of the tax on to consumers as they are less concerned about the quantity demanded dropping. Draw a graph showing a tax placed on a good with elastic demand and label the incidence of tax. Here's the answer. The demand curve is elastic, so relatively flat. The tax curve is to the left of the supply curve, resulting in QT, PC, and PP. The tax paid by the consumers is smaller than the tax paid by the producers. Draw a graph showing a tax placed on a good with inelastic demand and label the incidence of tax. The demand curve is inelastic, so relatively steep. The tax curve is to the left of the supply curve, resulting in QT, PC, and PP. The tax paid by the consumers is larger than the tax paid by the producers. Does the government receive more tax revenue from goods with inelastic or elastic demand? The government prefers taxing inelastic goods because they receive more tax revenue. You can see that when we compare the two graphs, the tax revenue is larger for the inelastic good than it is for the elastic good. Alright, that was the final video in our series on elasticity of demand. If you found this video at all useful, please consider subscribing and hitting the like button. By subscribing, you help us to continue making free New Zealand-based economics videos. If you have any questions about what we've covered, drop it in the comments below and we'll reply to you. You can also let us know in the comments what you'd like us to cover next. See you next time for more big brain energy.